Hello, welcome to IGO. That's In Good Order, the podcast for financial practitioners looking to scale with confidence and clarity. I'm Ben Braverman, Senior Consultant at SMS Financial Solutions, and let's get in good order. Today, we're with my main life insurance guy, Tom Pecoraro. Did I say your name correctly there, Tom?
Pecoraro. But yeah, I mean, it's when everybody sees it, it's the same thing, right? I just always say it's really good phonetically.
Yeah, which is always why I affectionately call Tom Tommy P. What Tommy P and I are going to discuss today is IUL as a solution and as a complement both to annuities and assets under management. I work with a lot of producers who do leverage index universal life insurance, but I work with just as many large offices, IARs, registered reps, and insurance only agents doing large quantities of annuities, maybe some long-term care, maybe leveraging Medicare in some capacity, but they don't do any index universal life or cash value life insurance, period. Tom is without question the foremost expert on IUL inside the SMS Financial Solutions ecosystem. With that in mind, Tom, would you be so kind as to tell us a little bit about your background and experience?
About ourselves. Yeah, I've been in, I guess, the financial solutions space for going on about 20 years. Primarily been focused on life insurance. It's one of the hardest, easiest things to talk about, right? I think trying to spend a lot of time really focused in that spot has been really beneficial for me, not only in my career, but just personally as well. I truly, truly believe in life insurance, and I think that's what sometimes maybe comes through in some of the things in the way that I present and the way that I think about it, not only getting, you know, ruffled feathers when people say they don't believe in it or don't do things like that. It it always kind of resonates a little bit more personally with me. So being someone that's actually delivered a death claim, that definitely changes you and changes your perspective.
I think that's exactly what I'm hoping to accomplish today, right? Because IUL can be underused, misused, and I think sometimes simply avoided for those reasons. So, but when it's positioned properly, it can be a client differentiator and probably make clients more sticky because you're unlocking the properly structured features of index universal life insurance that could be a differentiator or will be a differentiator in their retirement. So, with that in mind, let's talk about the current IUL landscape. What right now is the biggest misconception right out of the gate that you still hear from advisors when it comes to IUL, Index Universal Life?
Misconceptions, right? There's so many of them. I think that one of the biggest ones that I would probably say is this idea that it's kind of an investment in disguise, or it's a way to get rich tax free kind of thing. And I think that's a problem not only for the consumer, but it's also from the producer perspective as well. Um, it goes back to what is an IUL, right? It's life insurance first, not an investment. We talk about how they're, kind of sometimes people market them as this Roth alternative or magic-free retirement account, those kind of things. But with
I've
it
heard
being,
synthetic Roth before,
yeah,
which I'm sure if
exactly,
compliance is listening, they would just hate, right? Yeah.
there's all these wonderful ways that they want to try to say it, but I think that's the big misconception, right? That's the big kind of idea of how are you positioning it? And I think if you don't position it correctly like that, you put yourself not only in a bad position to, I don't know, I don't want to say make the sale because I don't think it's necessarily you know, a sale kind of idea. I think the sale needs to be around teaching and understanding as opposed to selling, right? So when we sell something, we're trying to convince them that they need it. And I think the education piece around it is way more where it needs to be. So, um, it's there's a savings component within it, right? But it's also the indexing. So really, where is it at? It's protecting, right? So because you have the death benefit, but also too, it's understanding that you don't have this kind of magical, uncapped kind of idea, right? Returns and everything are capped; they're limited, but you have downside protection. So thinking of it as more of a steady or a moderate type of growth and protection, I think is a much better way to kind of frame it or pay attention to it. You know, it's a long-term financial tool. Where is it really set up properly? Is this if it's used for tax advantage income, right? Life insurance
And
coverage.
and we'll get to that, but I
Yeah.
like what it seems right out of the gate. The misconception is the way that some producers or some agents are positioning the strategy, which we encounter the same thing within the fixed indexed annuity world, insofar as this is in no way, shape, or form an equity replacement. As Tom Hegna says, this is a AAA rated bond with a triple C like return and zero
Uh-huh.
standard deviation. Regardless of where interest rates have allowed participation rates and cap rates to get, whatever that illustration says, fundamentally, we're here to hit singles and doubles, not home runs, and get that ideally 5, 6, 7, maybe 8% rate of return. That's at least the story that I feel most comfortable with when I'm positioning an indexed annuity. Is it fair to say that when you're appropriately positioning the expected earnings on an index universal life policy, is that where some of the misconceptions or discomfort come from? Is that the illustrations are way outpacing what in reality the client should expect?
No, 100%. And I think you kind of dance around this idea that I like that it's this from a sale perspective, it's this set it and forget it. It's not a product that is set it and forget it. It is something that needs to be reviewed. It needs to be paid attention to. Yes, you have downside protection and it's geared for that moderate long-term kind of gain, but it doesn't mean that you can just, you know, not pay attention to it for the next 10, 15 years, right? There's definitely things that you want to kind of pay attention to it. So I think from those kind of ideas, right, that you're talking about, all those things point towards how are you really going to position an IUL? What is really the that kind of, I guess, framework that you're going to put around it to go, how am I utilizing this product in my plan? And I think that's the bigger picture, right? The bigger picture is utilizing it in the plan as opposed to so many people want to kind of if that, then this, or I only sell this, or I only sell that, or I'm really comfortable here or really comfortable there. And I think it misses the bigger picture of what's the overall landscape look like for the plan for the client, and are you doing all the things that need to be done for that client correctly?
So, just like when we're positioning an annuity relative to assets under management or as a complement to some type of security, if you're building a retirement plan from scratch with an IUL,
Uh-huh.
is it the same approach to a question I really like to ask is this money for living? Is this money for dying?
Yeah, I think it's a good way to kind of look at it because it's kind of this idea where does the IUL fit in almost, right? So when you're looking at a retirement plan, some people will say, hey, I mean, they use a lot of different, whether it be analogies or ways to describe what you're doing plan wise, right? Buckets, different buckets. So I'll stick with that one because it's kind of common out there, right? So you have your taxable bucket, you have your tax deferred bucket, but most of the time people don't pay attention to the tax free bucket. And in the tax free bucket, there's usually that's where you find the IUL, right? Now, people talk about Ross and, HSAs and all these other things, but it's geared towards this lifetime protection and this tax-free kind of growth opportunity that I think is really lacking in a lot of retirement plans at this point. Because I think everybody wants to focus on the Roth, right?
I certainly do, because that's what I best understand and I'm most comfortable with. And one of the goals
Yeah,
of the episode today is to get our listeners who aren't, and there certainly are plenty of producers leveraging IULs as a complement to AUM and annuities, but I want to try
uh-huh,
to get people more comfortable with IULs because
sure,
Tommy P says it works, and I trust Tommy P. Ideal client profiles. Right? I've heard about the active saver. We really want to focus on the retirement market. So, can you give us some ideal client profiles and a differentiator between annuities and life insurance, right? Is you're going to get stuck, you're going to have to do labs, so there's a health component to it as well.
correct. I think it's funny because that question gets asked of us a lot, right? And I think this has become common language right now in our industry. This, what's the ideal client look like? And the funny thing is I say this all the time, and I talk to my producers all the time about this, and they ask, what's the ideal client? And I've kind of changed my answer over time, right? It's always been this 40 to 55-year olds, that are looking for kind of this thing. But now that you've really started looking at it and where it kind of fits in, newborns all the way up to 60-year-olds. So anywhere within there is always a good opportunity. And let me kind of explain that a little bit.
Please do.
Why do I why do I say newborns, right? A lot of people, so a lot of conversations that we've been having around whether it be maybe grandparents, right? Grandparents always kind of have been this one that people talk to and they want to do like maybe a whole life or something like this, a small face whole life for their grandkids. Well, why not start an IUL for them and fund it and then gift the policy to them for them to fund it? You've locked in their insurability for life, and you now have the ability for that child, grandchild, to fund that thing all the way to retirement. An incredible amount of growth and things can happen over that amount of time. So why would we leave that segment out, right? So some of the things that you see now is people transitioning going, hey, maybe grandma or grandpa isn't able to get the life insurance policy and they're frustrated. So why not make sure that their kids or their grandkids are set up and make sure they don't run into the same consequence that they're running into, right? So,
This could be a great short form sales idea for the YouTube channel.
sure.
So you have a grandparent who wants to leave a legacy to their grandchild, but is not insurable, and there's only so much you can do relative to just gifting non-qualified
Uh-huh.
assets. And in terms of passing on qualified assets, that's a whole episode in of itself with the Secure Act 2.0 and the inability to stretch that based on your life expectancy, basically giving most adult children or young children for that matter, qualified tax bombs. So I'm in my 80s or my 70s. I'm not insurable in any way, shape, or form, but I could actually start an index universal life insurance policy on my young grandchild or toddler.
Correct. Yep. As long as the toddler is 2 weeks old, you can start a life insurance policy on it. So what
And
we've
how
kind of,
could they even start one for?
what's that?
How little could
So,
they even start one for?
I mean, I've seen them as, people put, $50 a month or $100 a month. Now, on the flip side, you kind of talk about, hey, grandma or grandpa was looking at a life insurance policy for themselves. So my sales idea is the premiums that you were looking to put in for yourself, just take those premiums and put them in for the grandchild. Now you're transferring that wealth to them tax free.
This is a really interesting idea because we oftentimes in the annuity space run into people in their late 70s or 80s sitting on a lot of non-qualified assets, post-tax dollars. It's just sitting in the bank. They're
Uh-huh.
going broke safely. We could maybe put it into a fixed index annuity or MIGA, which is a certainly an okay solution in some circumstances. But this is a nice pivot to start helping them create this retirement strategy for their children. So that's a great idea right there. I like that. And then I think this is going to help producers understand. So then that grows over the course of 60 years or
Yes.
65 years. And then at that point, that is a quite large tax-free legacy. So are they funding it throughout the entirety of that 60 to 65 year time frame?
Yes, they can. So a lot of it you see the way we illustrate it, right? So we'll run it to age 65, 70. I've kind of had these conversations a little bit more with people, especially for grandkids, maybe going out to age 70, because that's probably when we talk about 40, 50-year-olds, where we think in retirement, probably age 65, maybe 70. I get it. But for young kids, especially like newborns or, anyone under the age of 10, you're probably looking at age 70. So if you're paying, just for talking purposes, a year all the way to age 65, and that thing is growing, exponentially over time, and then you have this bucket. Right? But I think another piece to think about, and here's one of the other areas that I think kind of gets overlooked too, is what happens at 30 years old with all this cash that they've been growing over the last 20 years, and they want to start a business. They can
They can
access that.
access it.
They can access it. So people don't talk about the early access points of life insurance. So it's a huge, huge opportunity in IUL with the cash growth that I can access it at any point. I don't have to wait till 59 and a half. I don't have to wait. I don't have to have certain amounts. I have other things that I can kind of just tap into. The other side is I mean, it brings up the conversation, right? When is a good time to tap into, 401ks or all these other investment accounts, right? What if the market's down? Most people always tell you, oh, hold on, just wait. Don't access any of that from that account because you're going to take a bigger hit. Well, do you have a life insurance policy? If you have a life insurance policy with cash growth, you now can access to offset some of that, right? So I think those are other pieces to kind of where it fits in here, right? It fits in with the grandkid conversation and in 20, 30 years being able to do it. But what about for, the 40, 50-year-old, 60-year-old that is now approaching a retirement? Maybe had enough money to kind of get these IULs going and overfund them a little bit. Now I can access it when it's right for me. So when the market structure is not right for my other plans, I can access my cash value from here.
That's what I wanted to touch on next. So we're building a retirement plan from scratch today. We have a 50 to 55-year-old insurable. Uh, a majority of their assets are in IRA assets.
Hmm.
Where does the IUL fit? Let's say they do need income at 70. I would immediately say, okay, we're going to put the money to work with a guaranteed income rider on an FIA, and that's a great solution. But could we not take a portion of those IRA assets, unwind them to fund the IUL? Let's have the income conversation, and then we'll have the legacy conversation.
Well, I think it starts with the first question is what do you expect taxes to do,
Go up.
right?
Yeah.
Everyone expects them to go up. So why are you not building a tax-free bucket, right? Usually when you talk about retirement plans, what are we starting with? We start with 401ks, Roth IRAs, max funded Roth IRAs. And then no one talks about the IUL because I'm max funding the Roth IRA. Well, what's the max amount you could put in on a Roth? I think it's now 7,000 a year, right? I think, don't quote me on that, but I think it's around 7,000. What if I have more than that? So what are you doing with that other money? right? So I don't want to sit here and say that, a Roth IRA is bad. I think they're good. I don't want to say a 401k is bad. They're good. But what are you doing about the ability to offset some of that? When you've maxed out all those other spots, what are you doing with that, sideline cash, we like to say? What are you doing with those things? Why aren't you putting it into, a tax-free bucket?
What a great point. And I hope in subsequent episodes and so far that we've really communicated to listeners, we're advocating for a balanced approach to retirement planning.
100%.
It's not all or nothing. It's not all
Exactly.
annuity. It's not all assets under management.
Mm-hmm.
Uh, I'm teasing next week's episode where we'll be talking about hybrid and traditional long-term care,
Uh-huh.
which is another underused and underutilized insurance strategy. It's not all Medicare. It's bringing that together in a comprehensive plan. And I think about the sheet you talked about, the lazy money or the cash on the sidelines. There's
Correct.
trillions and trillions of dollars of cash on the sidelines. In fact, I don't know if you've seen the meme stock frenzy, but there's a lot of analysis that says that that is coming from millennials who are not in a position to get a house because of interest rates. So they have a surplus of cash and they're saying, well, I may as well throw this at something. If I'm going to throw it at something, I'm going to throw it at this, American Eagle stock or something. This is not an investment podcast. That's just my side analysis that I am regurgitating that
Yes,
somebody else said.
exactly.
But there's validity there and there's an opportunity there. What if they, as a complement to their taxable brokerage, and hear what I just said, as a complement to taxable brokerage? Because I think you could also
Yes.
make the argument that if somebody puts if somebody at age 18 or even earlier starts dollar cost averaging into a low cost ETF for their entire life, they're going to be sitting pretty by the time they're in their mid 60s as a complement to their 401k, their Roth contributions if eligible. But what if in addition to that they were contributing to an IUL?
Well, you nailed it all. And then there's also the component about IUL that everybody, I think it's the bigger elephant in the room, right? It's what happens if you don't make it to retirement? What happens to all those accounts? What happens to all this investment things that I've done? What happens to all this, asset that I've grown and I've never actually tapped into it, right? So where's it move? How does it move? How is it taxed? All those things come into play, right? So it goes to the next generation. Usually there's tax implications. What if the next generation, what if your kids can't handle that, right? So now they start selling off assets. They start selling things off to pay for it. Whereas if you had this tax-free bucket that also has a death benefit and it comes to you tax-free, usually within weeks after passing, now your kids have the ability to offset all this, keep everything that you had in place in play, and now utilizing that death benefit too. So, I mean, so many people think about a death benefit just from legacy planning, right? And I think it's more than just legacy planning. Yes, we talk about estate protection and estate plans and how are you doing all that. And right, most people aren't truly probably that concerned about their estate. But I think when you've worked really hard, even if your estate isn't that big, when you've worked really hard to build and acquire these assets, the last thing that you want to see happen to them is go away because the next generation can't afford to keep it around.
Let's talk about some common objections to IUL. And I hope so far what listeners have gathered is
Mhm,
appropriate positioning, appropriate expectations,
mhm.
complement, not all or nothing. Building trust around the product. It's too expensive. It's too complex. I heard it doesn't perform. We've covered, I heard it doesn't perform. What's your favorite way to simplify the IUL story for clients? We talked about what we would do for the older clients. We talked about how this could help the active saver, younger client. I want to narrow in on the 55-year-old or the 60-year-old who is insurable. Uh, They have an IRA, they have some non-qualified assets. Simplify the IUL story for that client without dumbing it down too much, of course, but where let's again tap into where does that fit? I'm a 60-year-old and you're saying, "Hey, we should also introduce an index universal life policy into your plan as a complement to your annuity and your assets under management."
Well, I think it's more getting away from the heading, right? So the last thing I'm going to say to you is, Ben, let's talk about your life insurance. Because what immediately happens when I say that? You immediately go, I'm good. My life insurance is taken care of, whether it be I have term insurance or I have these other things. But if I said to you, Ben, if you believe, and we've had this conversation before, and I know where your stance is that taxes are going up, and I know you've maxed out all these tax deferred kind of buckets, what are you doing about your tax free bucket? And if I could show you a product that runs alongside the market, you have downside protection. Now, yes, you have some caps at the top, but you have downside protection. And we can kind of put this in, and it's actually a self-fulfilling. So if God forbid something happens to you, it's transferable, probably even more to the next generation. Would that be a product you would be interested in?
And you haven't even mentioned IU. You haven't
I've
even
never once
mentioned.
said life insurance.
Yeah, and it's not like you're trying to backdoor or anything in between. It's like with a lot of strategies, it's an uncomfortable topic because you're talking a little bit about death in some capacity, but you're talking about death with efficiency,
Well,
right?
I think it's the idea of really looking at IUL as what it is. Yes, it is traditional in itself, life insurance. But what does it do? What are all the benefits of it? And where can that benefit your client? And I think so many people look at it and want to reverse engineer it and go, well, I need a $500,000 death benefit. I never once asked you about your death benefit. I didn't ask you about your legacy needs or anything like that. I was really just talking to you about a tax-free component.
And is
Now,
that what separates the top 10% of IUL producers? Because in every episode, I also try to narrow in on whether it's seminar marketing, annuity production, long-term care, assets under management, business development, personal growth, what separates that upper echelon of producers? And
100%.
they're
That's
talking
the
taxes.
they're talking about it as a plan and part of the plan as part of, hey, we need to talk about your life insurance. Right? I mean, I get it. There's definitely a need for it, right? Especially for younger people, people in their 30s. They're going to have a much larger death benefit need, right? Maybe they need income replacement, mortgage protection. There's a lot of things, but okay, I get the idea of having, a term policy to cover the majority of that. But why are you not talking about an IUL for the future? So
What's
why
it?
isn't that part of the plan? So again, it goes back to, the tax-free retirement, you know, obviously, do you think taxes are going up? Those kind of things. What happens if your investments underperform? What's your plan for that? Do you have a plan for if all these investments that you're using don't work? So these are all the areas that as you kind of uncover, maybe we'll call them the pain points, right? You're going to figure out, wait a minute, there is a need here because they do have a pain point that an IUL will solve. So why wouldn't I add it into my plan?
That was great. And there's riders, chronic illness riders, accelerated death benefit riders, living benefit riders. That's not what I really wanted to get into today. What I wanted to get into today is
Yep.
we hear IUL, and for some producers, it's an automatic no thank you. I mean, seeing how I had a securities license, which I've subsequently dropped, but way before I ever had a life insurance license and way before I ever touched annuities, I do understand the trepidation
Oh,
for RIAs, registered reps, or top producing annuity agents. If it's not broken, I'm not going to try to fix it. But I believe you can make your clients stickier and by appropriately positioning IUL, be that for a portion of tax-free retirement or tax-efficient legacy planning, not just a death benefit, as you said, to cover a certain expense, but to transfer assets
Mhm.
in a tax-efficient way. I A big takeaway of Ed Slott, who was a keynote speaker at our summer sales symposium, he said life insurance is the most tax efficient product or strategy out there, full stop.
Mhm.
And that's
Yep.
when I said, I really need to get this message out to my producers some more. And shameless plug for Sales Forum. That's the first week of June in sunny Omaha. Start asking people at SMS about it today. It's a great event where we cover our health to wealth platform back and forth. So, what should advisors do after this podcast if they want to get serious about IUL? Besides, I mean, obviously, talk to Tommy P.
Yes.
But
Obviously, that's the biggest thing, but it's really around let's let's help you get educated around it and the proper ways to structure it, the proper ways to look at it. But understand we have a lot of different ways to make it work for the problem that the client has, as opposed to trying to fit the client into a product.
I
There's a
I
lot of
like that. Can you
there's a
say
lot of
I
different
that was great. One more time.
trying to fit the person into the product, but rather designing the product around the person. So another way of saying it, I gave it to you in a little different way so it didn't sound so scripted.
So you
Um,
could do a book review and say, here's my clients,
mhm,
here's their annuity, here's their term, here's hopefully their long-term care policy, here's how much they have in assets. Is this worth having a conversation
correct.
relative to their
And yep.
insurability?
And I think it goes back into then when you come back to them. So the advisor's coming back to them as this isn't talking about your life insurance. This is talking about your plan. Here's your plan. And now we need this component to fit into your plan, and here's how it fits in. And
Tommy P, I think this was really illuminating for me. I know Index Universal
thank
Life
you
has
so
a
much for
place.
having it. So many people don't, want to have these conversations and they want to run away from it and they get nervous about it. And it's, like I said, it's not that hard. It's just a matter of kind of getting some of the details and some of the key features and then just positioning it from the feature standpoint as opposed to a product standpoint.
Well, in the interest of transparency, I was a little nervous about this episode. For one thing, I'm coming off of a summer cold, if anyone can hear it, which I think is the worst type of cold to get when it's 95 to 100
Exactly.
degrees outside. But in addition, do I have a somewhat of an understanding of Index Universal Life?
Uh-huh.
Yes. Do I have a firm understanding? I would be transparent and say no. And also, do I see a lot of the negative publicity around IUL when it's not properly structured? But the way you've described it, it seems like there's many, many different ways to use it, and it doesn't need to be a Swiss Army knife with a number of dull blades. But what we need to do is pinpoint where does it fit for the client and not use it in an arbitrary manner, much like annuities or any other strategy.
Yeah, it's the idea that, it kind of like your analogy, the Swiss Army knife, right? It's got a lot of components and we can do a lot of things. It may not be perfect at everything that it does, but it's going to do a lot of things well.
Perfect. Well, listeners, if you like what you heard today, contact me and I can get you in contact with Tommy P. At some point, Tom, I'd love to have you back on the show, and I'll promise to pronounce your last name correctly. My apologies there. It wasn't meant to be insulting.
No, 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 I get it. I completely understand. Been down this road many, many times. And I always say, I've lived with this name my whole life, so I'm very, very aware of no one being able to do it. Just because I think it's easy doesn't mean anybody else does.
Tom, before you go, we always like to end IGO in the following fashion. With the decline in many industries in terms of service quality, customer service, I always like to ask our guests, what's a good or great customer service experience you've had recently? Doesn't have to be in the financial services industry. Our guest last week talked about Marriott, much to my chagrin, as my wife works for Hilton. But as long as you dodge that, I think we'll be safe. Fire away, Tom.
It's such a funny thing, right? Because as I'm thinking about that question, what's the first thing that goes through my head is how have we downplayed customer service, right? What do we now accept, right? So it would be kind of sitting at the restaurant, you get maybe a little bit extra, like for example, we were just at a restaurant. My daughter leaned over and she's like, "That waitress is really good. My glass never went below half full." And why, albeit very good customer service, right? I enjoyed it, tipped accordingly because of it. But what have we kind of allowed to be seen as good customer service and what really is good customer service, right? So
So go
I
ahead.
think it goes back into the idea of what's important to you. And I think it's more important to what's important to the person that you're serving, right? So good customer service has to be looked at from I'm trying to provide you with your experience, not me trying to provide my experience and hope you fit into it. So I kind of like it from this idea that don't don't if you're providing service and you're in the service industry, don't think of it from your own perspective. What's the person on the other side of the desk perspective? And then try to overdo that. So it's kind of the way that I try to approach it. I don't want to I don't want to provide customer service that I think is good. I want the service that I provide that you think is good.
And that's all the more reason to open up feedback loops. That's one of the more
Hmm.
esoteric or sage responses we've gotten to the question on IGO. But I really like that. It could open up another few minutes of conversation. But I think
Well, I
what
think
you're
it's tough,
saying
right?
is
Because
spot on. No, because you have advisors doing seminars, doing webinars,
mhm,
producing content. What is the expectation and what are you trying to fulfill on the other end? Think about the end user because we're all acting in
correct.
some way in a service capacity. Sage wisdom from Tommy P today on IGO. Uh,
Well, I'm
tune
glad I
in
could
next.
provide it.
Thank you very much, Tom. Tune in next week, everybody. We'll be talking to Drew Carpenter about hybrid long-term care, traditional long-term care, and a new offering from SMS Financial Solutions, point of sale long-term care consultation. If you like what you heard today, like, listen, subscribe, resubscribe, be that on YouTube, Spotify, or Apple Podcasts. Tommy P, thank you so much for being on IGO and have a fantastic day.
Appreciate it. Thank you so much.
Be well.